Hi everyone, welcome back to Corporate Decoder, the place where we decode the financial jargon so you don't have to. Today we're looking at Klotho Neurosciences, and it seems they've been navigating some tricky waters with their stock price, but it looks like they might be coming out of the fog. Let's dive in and see what this report really means for them. Before we get into the nitty-gritty, if you enjoy getting clear, no-nonsense insights from these complex corporate filings, make sure you're subscribed. And if you want to keep the conversation going and connect with other finance enthusiasts, join our Discord community. The link is in the description below. Alright, so what we have here is a Form 8K filing. Think of this as a very important update that a company needs to release to the public pretty quickly when something significant happens. It's not like their regular quarterly or annual report, which gives a broad overview. This is more like breaking news from the corporate world. Now, the most important date here is July 14th, 2025. This is when the key event happened that they're reporting on. This is Klotho Neurosciences Inc., the company we're looking at. They've got common stock trading on the Nasdaq stock market LLC under the ticker symbol KLTO. They also have warrants, which are like options to buy stock later, trading under the symbol KLTOW on the same exchange. Klotho is also flagging itself as an emerging growth company. This means they are a newer company and get to follow slightly different, often more relaxed rules for financial reporting compared to older, more established companies. It's a way to ease them into the public market reporting. This section is where the real story is. It's all about whether they are meeting the basic requirements to have their stock listed on the Nasdaq exchange. Most companies want to be on a major exchange, like Nasdaq, because it makes it easier for investors to buy and sell their stock. And it gives them credibility, but there are rules you have to follow. So here's the big news. On July 14th, Klotho got a letter from Nasdaq saying they've met the requirements to stay listed. Specifically, they were struggling with two key things. First, the stock price. Nasdaq wants the stock to trade at a minimum of $1 notice. If it dips below that for too long, they can get delisted. Klotho has now made sure their stock price is back above that $1 zero mark. Second, they also had to meet a minimum stockholders' equity of 2,500 to get invested in it. If this number gets too low, it can be a sign the company isn't doing well. Klotho has now shown they have at least $2.5 million stockholders. Equity is essentially what the owners of the company have invested in it. If this number gets too low, it can be a sign the company isn't doing well. Klotho has now shown they have at least $2.5 million in equity, meaning they've gotten their financial house in order enough to satisfy this rule. This is a huge relief for the company and its investors because it means they won't be kicked off Nasdaq for these specific reasons. Failing to meet these can be a serious blow, making it much harder to raise money and trade the stock. But there's another twist. While they regained compliance, they also decided to move their listing. They are phasing down from the Nasdaq Global Market to the Nasdaq Capital Market. Think of the global market as the main, more prestigious part of Nasdaq, usually for larger companies. The capital market is another tier within Nasdaq, often for smaller companies that might have lower market capitalizations or are still growing. This isn't necessarily a bad thing. It might mean they are acknowledging their current size or looking for a market that better suits their stage of growth. It's a strategic move that can still provide a solid listing platform, but perhaps with different expectations or requirements. This next part is about how they are communicating this news. Regulation FD, or fair disclosure, is all about ensuring that when a company releases important information, they do it in a way that everyone gets it at the same time. They can't tell one big investor before they tell everyone else. This confirms that on July 16th, which is just a couple of days after the actual event on July 14th, they put out a press release. This press release is essentially their official public announcement about getting back in compliance with Nasdaq. This sentence is a bit of legal boilerplate, but it's important to understand. It basically means that this particular press release, even though it's part of this filing, isn't going to be treated as if they are officially filing it in the same way they file their main financial reports. It's more of a disclosure to keep people informed. This protects them legally, saying that this press release isn't the same kind of legally binding financial statement. Now, every company includes these forward-looking statements. They're essentially saying, hey, we're talking about the future here and the future is uncertain, so don't sue us if things don't go exactly as planned. This is the disclaimer part. They're warning that many things could go wrong. They might not be able to execute their business plans. They might miss opportunities, or their financial predictions could be off. Also, changes in rules or the competitive landscape can affect them. So while they're getting back on track, there are still risks ahead. This section just lists the documents that are attached to this filing. This tells us that Exhibit 99-1 is the actual press release they issued, and Exhibit 104 is the digital document that makes the filing searchable for computers, which is good for data analysis but not something we need to get into detail about for our purposes. Finally, we have the signatures. This is where the company officially authorizes the filing. And here we see that Joseph Sinkel, the Chief Executive Officer, has signed off on this report, confirming that everything in it is true and accurate to the best of his knowledge. Now, looking at this filing, the story is clear. Klotho Neurosciences had some serious issues with their stock price and shareholder equity that put their Nasdaq listing in jeopardy, but they've managed to fix those problems and have now been confirmed by Nasdaq as compliant. The move to the Nasdaq capital market is a strategic one, likely allowing them to operate in an environment more suitable for their current size. What's the takeaway here? For investors, this means the immediate threat of delisting is gone, which is a significant positive. It shows management is capable of addressing critical requirements. However, the fact they had to move to a lower tier market suggests they are still a smaller company facing growth challenges. The real test will be their ability to execute their business plan, turn a profit, and potentially move back up to the global market in the future. They've cleared a hurdle, but the race for long-term success is still very much on. What do you think about Klotho's situation? Does this move to the capital market signal a strategic advantage or a step back? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe so you don't miss our future deep dives. And definitely check out our Discord channel in the description to continue the conversation. Thanks for watching, and I'll see you in the next one.